You know that feeling, right? That knot in your stomach when you're trying to guess which way the market is going to go next? We spend so much energy trying to be fortune tellers, staring into the market's crystal ball. But what if we've been playing the wrong game this whole time? What if the goal isn't to predict the future, but to profit from what's happening right now? Let's take a look at a completely different path.
So what if we could just stop trying to forecast the unpredictable? In this explainer, we're diving into some fascinating research from Dozen Diamonds. They introduce a method that totally flips the script, turning the very thing most of us fear, volatility, into a systematic, monetizable source of profit.
At its heart, this is really a tale of two philosophies. On one side, you've got prediction. It's stressful, it's fragile, and it's completely dependent on your forecasts being right. And on the other side, you've got reaction, a calm, rules-based approach that's built to be resilient. We're going to see what happens when you make that mental shift from predicting to just reacting.
So what's the big deal? Why is prediction so tough? Well, most financial models, they lean heavily on past data. But the source paper points out that markets are what they call non-stationary. Now, that's just a fancy way of saying the rules of the game are always changing. What worked yesterday probably won't work tomorrow, and that's exactly where these predictive models just fall apart.
And this right here, this is the fundamental weakness. I mean, think about it. Every traditional strategy, from basic stock picking to super complex algorithms, they all have this one secret dependency. They have to guess the future correctly. And when that guess is wrong, the whole strategy can just crumble.
So, if we can't rely on a forecast, how in the world do we trade? Well, that's where the stressless trading method, or STM for short, comes in. It's what you'd call a deterministic framework, which basically means it doesn't care one bit about which direction the market is headed, it simply reacts to what has already happened. And the logic behind it is, it's beautifully simple. First, you set a price interval. Let's call it a step size, say $1. If the price drops by one step, you buy a fixed number of shares. If the price rises by one step, you sell that same number of shares. That's it, seriously. No emotion, no guesswork, just simple rules.
This is the absolute key takeaway. STM is not about trying to anticipate the market's next move, it's about having a pre-planned, automatic response to the move that just occurred. You're basically trading the past, not trying to predict the future.
Now, I know what you might be thinking. This sounds way too simple to actually work. So let's get our hands dirty and walk through a real example from the research to see how this simple mechanical ladder can actually generate profit.
Okay, let's set the stage. The stock price starts at 50 rupees. We own 5,000 shares and we have 250,000 rupees sitting in cash. Our total account value is 500,000. And our rule is simple. We're going to trade 200 shares for every 1 rupee price step.
All right, here we go. The price drops to 49. Now, the system doesn't panic, it doesn't get emotional, it just follows the rule. It automatically buys 200 shares. And as you can see, our cash goes down a bit, but our share count goes up. We are systematically buying the dip, all without making a single emotional decision. And this just keeps on happening with every single 1 rupee drop. By the time the price bottoms out in this little swing at 45 rupees, the system has automatically made 5 buy trades. We now hold 6,000 shares because we've been steadily deploying our cash as the price went down.
But now the market starts to turn. As the price climbs back to 46, the rule kicks in again, just in reverse. We automatically sell 200 shares. And check out what happens to our cash balance. It's already starting to climb, capturing a tiny bit of profit from that price swing.
So the price keeps rising, and we keep selling at each step, until, boom, we're right back where we started. A price of 50 rupees. But look closely. Our share count is back to the original 5,000. But our cash, it's now 251,000 rupees. Our total account value is higher.
And this, my friends, leads to the $1 million, or in this case, the 1,000 rupee question. The stock price ended exactly where it began. So a buy and hold investor, they would have zero profit. So where on earth did our profit come from? The answer is in this really groundbreaking concept that the research introduces. It's a whole new way to think about performance that's all about the journey, not just the destination. It's a concept they call extra cash, or EC. Now, the best way to think of it is as real, spendable profit that's been skimmed right off the top of market volatility. This isn't some theoretical paper gain that could vanish tomorrow. We're talking about actual cash in your account, generated by the price's journey itself.
And this is the perfect illustration. In our little trip from 50 down to 45 and back up to 50, the system generated exactly 1,000 rupees of extra cash. That's the profit we saw. It didn't come from the final price, it came from the journey. So the really crucial idea here is this. Extra cash is literally volatility turned into money. It's a way of systematically harvesting the market's natural up and down movements and turning what everyone else sees as just random noise into a predictable cash flow.
Understanding this whole idea of extra cash isn't just some neat little trick. It actually represents a massive paradigm shift in how we can think about our investment performance.
Here's the difference in a nutshell. A buy and hold strategy only cares about the final destination, where the price ends up, period. But STM, it cares about the destination and the journey it took to get there. A really volatile path with lots of ups and downs can actually be more profitable than a straight line.
The research even backs this up with some pretty serious math, something called the profit parity theorem. What this all boils down to is proof that if a stock is volatile enough, if it zigzags enough to trigger a certain number of these buy and sell trades, this reactive method will eventually make more money than just buying and holding. It means profit can come directly from the chaos, even if the stock ends up going nowhere.
This really suggests we need to rethink how we even measure success. For decades, performance has always been about just two things: return and risk. But STM argues there's a third, equally important dimension: liquidity. How good is your portfolio at generating its own cash? That's what extra cash measures.
And honestly, this quote from the research paper just sums it all up perfectly. The goal is transforming volatility from a source of uncertainty into a systematic, monetizable feature of market dynamics. It's about seeing volatility as a resource to be harvested, not a threat to be feared.
And that leaves us with one last kind of provocative thought to chew on. For more than a century, finance has been obsessed with prediction. But maybe the real breakthrough, the path to calmer, more resilient investing, isn't about finding a better crystal ball. Maybe it's about not needing one at all.